Hello. Today I want to talk about the Fed funds rate, the 2-year interest rate, home mortgage rates, how this affects us as consumers, and what the Fed and interest rate is actually doing and what it's driven by, what controls interest rates and the Fed funds rate. So let's get started and let's give you some practical tips at the end of this that hopefully make a lot of sense for us to base decisions upon. Okay, so the first thing I want to talk about here is this chart is the 2-year. So basically the 2-year treasury rate or 2-year interest rate, and then Fed funds rate. Okay, so what I want to point out going back to 2016, 2017, is anytime we see a big divergence between this red line, which is the Fed funds rate, and this blue line, which is the 2-year, you're going to see the Fed move. And what you're going to see on this chart is that they are always following the 2-year. Okay, so you see here, this Fed funds rate was stagnant for a while. The 2-year starts to go up, the Fed funds rate starts to go up. The 2-year starts to go up, the Fed funds rate starts to go up. You can see here, again, another spree where the Fed funds rate went up and they followed the 2-year. Obviously, big difference here, and they continue to follow it up. Obviously, right here for a while, they were congruent or they were close together, and the Fed didn't move the Fed funds rate. Okay, obviously here, mid-2019, the Fed lowered. Obviously, in my opinion, 100% because the 2-year had been lowered. Same thing again here in late 2019. And you'll see here, right before COVID, there was a calm before the storm where the Fed funds rate and the 2-year were about the same. And then here during COVID, you're going to see a massive fall off of the 2-year. And what does the Fed funds rate do with a little bit of a delay? It follows. Again, 2-year continuing to crash. What does the Fed do? Follows. Always you're going to see the pattern of the Fed following the 2-year. The Fed does not control interest rates. The Fed follows interest rates, in my opinion, of course. Okay, you'll see here a big bogey, early 2022, a big difference between the Fed funds rate and the blue line, which is the 2-year. You're going to see this massive rate rising spree. Why do we think this happened? Obviously, in my opinion, because the 2-year had spiked. It went way up, kind of went up in a straight line. When does the Fed eventually slow down and stop? Closer to when the Fed reaches the 2-year rate. Okay, now there was a time period here where the Fed didn't lower, but interest rates came back up, and eventually once the 2-year did lower, the Fed funds rate did start to lower. You can see right here in the middle of 2024 that happened. And here recently, what we've seen is the Fed has said here during their last rate reduction in December of 2025, the Fed said that they might be slow to do another move. Why is that? Because they reached the Fed funds rate. So now that they're at the Fed funds rate, they don't have to move. Since all they do is follow the 2-year, they have no incentive to move interest rates. They have no reason to move interest rates. The Fed knows that they don't control interest rates. They know that they just follow them. The Fed likely knows that interest rates are controlled by future growth and inflation expectations. So what does that mean for us as consumers? That means if growth and inflation are on the rise, we are going to see interest rates rise. If growth and inflation expectations are heading down, we're going to see interest rates head down. Now, more importantly, and how this impacts us as U.S. citizens or as investors. Most people would think that this red line controls the 30-year mortgage. They think that the Fed funds rate and the 30-year mortgage are intimately linked. I personally do not. I think that the 30-year mortgage rates are controlled partially by parameters that the banks dictate, but also partially by risks that the banks are comfortable in taking upon themselves. if a bank doesn't want to take risk upon itself, it probably is not going to decrease interest rates, even if the Fed funds rate is decreased. Okay, the bank has to have some incentive to provide products that are going to both benefit consumers and benefit themselves. If interest rates get back down to zero, like they were here for a while, we were not getting interest rates on 30-year home mortgages anywhere near zero. We were getting low rates. I'm not going to deny that, but that's because the 2-year rate was very low. Right now, who knows if we're going to get interest rates going up or down in the future. What I would say is I'm not sure that it matters all that much. I know that it does for certain things, but by large and in general, the interest rates that we have to experience or we get to experience as consumers in the United States is almost all driven by future growth and inflation expectations in the 2-year. Okay. So this is just FYI, nothing that we can use here to make decisions off of specifically. But if we're interested in knowing what direction rates are headed from here, we need to try to have a good understanding of what future growth and inflation expectations, where they're headed, right? So if they're headed down, interest rates are probably going to be headed down. If they're headed up, if we're going to see growth move up into the future, interest rates are probably going to be headed up. And the Fed funds rate would probably be headed up again because the Fed just follows the 2-year. Jeffrey Gunlock was the first person that I heard ever point this out. I think he is dead accurate in his assessment, and I think he is 100% correct in saying that the Fed doesn't do much other than follow the 2-year. Hopefully this was helpful and entertaining. Have a good one.